Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, hey going? Phil Tarrant, host of the Smart Property Investor Show. Very special installment. We've done this twice in the history of the decade that we've been recording this podcast. In the studio with me is the only other property podcast you need to concern yourself with. They've also been at this for a decade, and I would imagine maybe a couple of months longer than what we have. The guys over at the Property Couch, Bryce, Holdaway, Ben Kingsley, joining us in the studio for what is 20 years of podcasting. I reckon good luck anyone else in Australia saying you've got 20 years of collective property podcast experience around the table. I call it 30 because there's 10.
Yeah, and you're not. And you're across so many, so that probably adds another 10 again.
Yeah, welcome guys.
Thank
How
you.
you going?
Good
So
to
we're
see
going to
you.
work out whether or not this is a Property Couch podcast or a Smart Property Investment podcast. So we'll just call it
Combo.
Combo podcast. What's going on?
The Property Smart podcast.
Yeah, the Property Smart. The Property Smart Couch podcast. Oh, God. So many podcasts out there now.
There are. And what's going on? We've written a book, Phil.
I heard.
Yes.
I heard.
And so-
I have a very nice one here that's it's got a personalised note in front of it, which I found quite nice and sincere. So thanks for sending it over.
Pleasure, mate.
Really good. How to retire on $300 a week, $3,000 a week. The Property Couch's playbook for passive property. I feel like that sometimes in my portfolio, $300 a week. Probably costing me that, but probably a little bit more. But the third book, Armchair Guide for Property Investing, was the first.
Yep, 2015.
Is that 2015?
Yeah.
Is that 10 years ago?
10 years ago. And then we had Make Money Simple Again, which was how to train yourself into managing your money and rules-based system. So you could obviously build the behaviours and the habits, because budgets don't work, but habits and behaviours and systems do.
Yeah.
So that was the second book. And then, we've put this book together after 10 years of the first book. And it really, sort of grabs all of the frameworks and process. I mean, look, we always talk about property investing is a process, not an event. We've been banging on the podcast for over a decade, trying to teach people some really powerful frameworks and systems and the way to think about things. And obviously in the last 10 years, a lot has changed. So it's basically a fresh look at all of the stuff we've been doing and the stuff we pretty much teach our clients every day to implement.
So all books are created equal, but some books are more equal than others. You've got a favourite, Bryce, of these three?
Definitely this one, and it sounds a little bit of confirmation bias or recency bias, but the first one we wrote was before we started the podcast, and what we were saying at the time when we released it is, did the world really need another property investment book? And we felt like at the time we had something different to talk about, right? And then over the last decade on the podcast, we did talk about that, and we talked about it in a way that we feel like we've added our contribution to the market on what to go for and what to avoid. So really, why did we go again? It was just because we felt like the journey of being on, and you know it yourself, Phil, when we were on the podcast, we got to speak to some of the brightest and best minds, economists, property investors, sharpest thinkers through that journey, and also 10 years more mature in our thinking and the way that we came up with the frameworks and some of the ones we developed along the journey. So we kind of think there's 40 years in a weekend here that you can actually start out picking up the book and then just building out some layers, so that at the end of the book there's genuine actionable steps that you can take that's built on evergreen principles that if you pick up this book in 2037, we wrote it in a way that we think that 95% of the principles in the book will apply in 2037 as much as they do today in 2025. So I think that's what the unique contribution this one makes to the marketplace is. It's not a moment in time. It's actually a way for you to have a fresh look on lifestyle by design and what it takes to understand the Australian property market. And if you are like us and think that residential real estate is the vehicle that you want to choose, then we'll give you the step-by-step playbook on how to do that.
Yeah, and we'll sort of chat a little bit about the book while you guys are also in the studio. I've got some things I've been seeing in the background, and as two professionals and practitioners who I rely on your insights, I want to sort of interrogate some of these points, which no doubt our listeners will really appreciate. But just to challenge something you just said there, Bryce, this collective knowledge that both of you guys have. When you think back to starting off in property and say 10 years ago when you did the Armchair Guide versus the book that we have today, do you fundamentally feel the same way around property as an asset class, or how much further have you advanced your sophistication over that 10 years when it comes to property investment?
Yeah, I do still believe in it because I think that it's a market that people can get into and understand it because it is the same as the essential need that they put their family in. I think over time the market has changed, and when I first got involved in property back in the late 90s, pretty much you put a name on a title and you'd get positive cash flow, right? And then fast forward to now, it's getting more and more out of pocket. So people are looking for alternatives to try and to shave that cash flow gap. But fundamentally, I think that the foundation of wealth creation for people who are in middle Australia, who don't know how to build a business or not in the lane of building a business, which I think is the greatest wealth creator there is. If that's not you, then I think that resi is a very reliable path that can set a foundation that at some point in time, as your level of sophistication develops, you get to choose other pathways. But for me, even, and you know it yourself with talking to our colleagues in the industry, even some of the best players in the commercial market still think the foundation starts at residential. So I still believe in resi as much as I did back then.
Yeah. I sort of said it beforehand, but I think property investment is the great Australian side hustle. Many Australians are obsessed with advancing themselves in many different ways, and a lot of them will pursue business initiatives, right? And let's be clear, most small micro businesses fail, and there's a hit rate of 50+% on it, right? What most Australians should be doing, this sounds very boring and maybe uninspiring, is that get a really, really good job, pay well, balance the family budget, read the book, all the clues are there, and use property investment as that side hustle, as that second job, because it's a lot more forgiving. The likelihood of success is a lot higher than one of these selling trinkets in a market on a Saturday, and you're largely going to get the outcome you want. And it takes time for people to realise that, but once they crack it, and you'll see it all the time, and we'll chat about sort of property investors in a moment, where they are, you become a CEO. You're the guy in charge. You're the girl in charge. You're there. You've got a CFO. You've got a chief strategy person, your buyer's agent. CFO is your accountant. You've got all these other people. You can actually sit there at the top of your own corporation, and the likelihood of being successful in business is much higher.
Well, look, I mean, if you think about our business, that's the way which we like the client to visualise it. That there's a board table, and they're the managing directors, and they've got all of their A team of trusted advisors sitting around, all trying to build their business in terms of, and the business is passive income. They want to basically build $3,000 a week or whatever that looks like. So I think that's a really important point. But coming back to what you were talking before about, in terms of what's changed in the last 10 or so years, or even longer, the narrative is definitely different, like in terms of the property narrative and the way in which the politicians and all that are trying to change that narrative. And now the media and certain, sort of sectors of the media are trying to change that narrative. And, they're claiming that when the capital gains exemptions, the 50% concession was introduced, that put a skyrocket under property. But that's just factually not true. Like, when they started making those claims, I went back to 1980 and I measured the difference between that period to when it obviously changed. The irony is, Phil, is that property prices grew by 7.4% per annum from 1980 to 1990 when the change, and then off the back of that, they've only been growing by about 7.1%. But it just looks worse because of the compounding nature, right? So, they're putting all of this narrative out there that, that basically it's, supercharged property investing and, we all get these big tax deductions and blah, 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 blah. The reality is if we didn't even have the incentives that we had, property is coming back to the point of why we believe in property, it's a status asset. Like in terms of it's where we live, but it's a way in which we represent ourselves in terms of, if we're successful, we have, how many property shows do we have on television? In terms of showing all of that. It's the great barbecue conversation because it shows that we've been successful in life and so forth. So part of the underlying belief in terms of why you're smart, you're smart because basically it's an asset that is pushed by owner-occupiers. And as investors, it's sort of low risk if the owner-occupiers are going to take it where they want to take it. So even if you took some investors out of the market, you're still going to have, if you've got a wealthy economy and a strong economy in a wealthy country, you're still going to have high property prices. So to think that we're solely responsible for the macro returns that are happening in property is wrong. However, you could also still make a case for, on occasion, sentiment, and we can move markets, from an investor point of view as well.
So I want to get to some of those points you mentioned there, and for those of you who haven't had the privilege of listening on as a fly on a wall to a phone call from me and Ben, we can get quite political with stuff and right the wrongs of the world. So I really want to touch some of those points, but around property as an asset class, you got three really big partners when it comes to this, and not counting yourself. You've got the banks that lend you money. They're highly invested in the integrity of the property ecosystem. You've got the government. Government doesn't want to be a landlord, so they're highly invested in supporting.
They can't afford to be a landlord.
They can't afford to be. So they're highly incentivised to support property investors to provide the economy, which is housing people. You also have your super funds who park most of their dough inside of banks for the Australian investor for their superannuation, and they want a great return out of it. So there's really strong architecture that sustains and supports property as an asset class. So they're good partners to have. However, and you say that on one side, on the other side, property investors are often seen to be the demon in the tax ecosystem, and no matter what you do as a property investor, you're not ever largely thanked for it. There's always someone with their hand out trying to tap you out for some more dough, and in many ways, it's because of the health of the sector and the integrity of it that it's a gift that keeps giving when it comes to tax receipts, and everything is around, and we'll get into it, how they can get more out of the property investor. And sometimes you feel like you're enemy number one when all there is every step of the way is you try and build yourself a wealth creation journey, and it's all in how to retire on $3,000 a week. So you don't need to rely on the government when you get to the point of retirement. They're there taking more from you. That's how you can feel. And you must hear it all the time.
Do you want to run through some recent stats?
Well, let's do it, but we'll go to a quick break because I want to get stuck into it. And I know there's some really good stats that recently come out from the ATI. Stay with us. We'll be back in a moment. Welcome back, Phil Tarrant, host of the Smart Property Investor Show, with the crew at the Property Couch, Bryce Holdaway and Ben Kingsley, just running through their new book, How to Retire on $3,000 a week. But I got you in here really under the premise of talking about your book, but I really want to get into the stuff that we're going to talk about right now. You like what I've done there, Bryce? I noticed on your podcast that you typically step aside when he sort of goes down this pathway, and you'll poke and prod a bit.
No, don't. Bryce is doing the right thing because at the end of the day, I'm the chair of the Property Investors Council of Australia. Okay. So I have, I advocate on behalf of property investors in the market. So I'm happy to pick the fights because at the end of the day...
Do you guys ever fight? About
we have in the journey.
Debate. About debate around ideas or concepts? Or?
No, I mean... we
healthy
debates.
We're passionate humans in terms of what we believe in. So, there's always...
10 years podcasting together.
Well, 15 plus years in business. So, no, like at the end of the day, it's pretty easy for Bryce and I in that respect because once we break down what we're debating, it's still in the best interest of the customer that we're debating. So there's nothing personal in terms of our debates. It's like, I'm coming from this position because I believe this, or I'm coming, but it also like, there's nothing between, what we argue about in terms of
personal. You don't get too political sometimes.
No, Bryce is pretty good. He's, I'm the one that's sort of outspoken.
That's what I'm saying. Not you. You're
Ben's definitely the outspoken one. But I think that a couple of the roles that he's taken on, largely, you appreciate this, but a lot of people don't. It comes at his own expense of his own resources, of his own time, largely because he's innately passionate about protecting the sector. So, and it's something that he is like gazelle-like in thinking, right? So, and I don't share those same passions at times because I know I got a front row seat to one of the greatest minds in this country when it comes to property. So we don't need the two of us to go down that lane. And so I think that he advocates for that really passionately. And And then when he gets off on a rant, I mean, no podcast needs two people ranting at the same time. So there's got to be a yin and a yang.
Bryce
Yeah.
gives me the soapbox to stand up on, and off I go.
Well, I have seen it many times personally, and I do enjoy it, and that's how we get stuck in it. But so some stats recently come out from the ATA, and everyone sort of gets absorbed about how many property investors there are in Australia. But there's some new numbers have been handed down recently, and I know there's probably a lag with this. It takes a little while for the boffins down in Canberra to work this out. But what's the latest stats on property investors?
So let's see if I can paint a picture here. So this is the financial year 22-23. And what I'm just focusing on is individual investors. So obviously you send a tax return for individuals, you send a tax return in for companies, and you also send a tax return in for self-managed super funds, as an example. So here's some of the top line numbers for those people who might get into a debate down at the barbecue or the pub or whatever in terms of what that story looks like. There was $33.1 billion of tax receipts for capital gains from property investors in that financial year alone. 33.1 billion. How many schools, hospitals, student debts is that help paying for?
So just to simplify this for not a very bright bloke like me, so that means that Australian property investors have sold a property.
Correct.
And through that, they've raised $33.1 billion that they're given to the Australian government.
Correct.
Okay.
So in the
I
business,
thought they were taking it away, not giving it.
well,
think so?
there's 7,300 less property investors than what we had in the financial year 21-22, and of those 2.26 million, I think it is roughly, roughly 51% are positively geared in their portfolio, and 49% are negatively geared in their portfolio during that time. Now, the context here is this. This was the time when the cash rate was moving. So remember, in May 22 was the first movement up, then we had the 13 rate rises. So before that time, you would have potentially had maybe 55%, or that could have been positively geared because there was a lot around neutral. And now the cash rate's coming back down, so we would expect that to come up. So you've got around 51% who are bringing or paying tax on the passive income that they're paying in terms of that income. And then if they're selling their properties off the back of whatever reason, they're cashing in or regulation, or it's getting too difficult to run their small private rental accommodation business, that's the receipts to government that are going into their coffers to, provide for the future services of this country.
So property investors are giving a lot more than what they're taking away.
Yeah.
And that's an important narrative too, right? Because what's not spoken about is the reason why there's a narrative around the property investors being the bad person is because of affordability, right? But the real reason there's an affordability issue is because the housing policy, the person who sets housing policy does not talk to the person who sets immigration policy. And we've just got more people coming here than we can handle and that we can build for. So that is the real problem. And if you actually look under the bonnet at the property investor, the same statistics will show you that here's the population of Australia, here's the very small percentage of them who buy an investment property. But then when you zoom in on that, the amount of property investors there are, it's a very large percentage of them stop at one. Yeah. So they're not greedy fat cats who are just cash and checks at the end. In reality, if you actually go into the other sector, which is the commercial property market, they're the ones who are usually got more cash flow. They've usually got more net wealth. They're usually more likely to fit into that stereotype. Whereas if you double click on the residential investor, it is the teacher, the police, like all of the public servants who are trying to self-fund retirement. So they are so far removed from the stereotype that we have to deal with, and they are not the contributor to the argument. It's the fact that we've got more people coming here than we've got houses, and we forget to actually talk about the very big picture that, sure, there's some tax breaks that are given out to keep people in the game, but at the back end, there's $33.1 billion coming in the back door in terms of capital gains receipts. It's net positive to the government, but that's not a convenient
you
narrative.
don't hear about it. And the $33.1 billion, let's break that down. We as in the Australian taxpayer,
and that's just the individual, Phil.
That's the individual.
So there's super as well as company profits coming off that. Now I'm going to give you a snap quiz.
Yeah.
Compare that to shares. Okay, so what's the tax receipts that we got from profits? So shares being sold and basically paying our 50% capital gains tax.
You put me on the spot. I'm gonna call it less than a quarter of that.
Less than a quarter. It's 15 billion.
Okay.
So basically, just under a half. So 15 billion. Because obviously all of these people who are lighting up Twitter and all of that sort of going on around. Oh, you guys are ruining it for. I mean, only 15 billion comes from investing into shares. 33 billion is coming in that year.
On individual tax returns.
Just on individuals.
Yeah. Okay.
So I mean, and what I think is missing from the debate, because I'm happy to have the debate. So there's money going back, which is great, but then there's also, of all of these people, a lot of those people might be in their 60s. There might be baby boomers who are tapping out, right? So what about the financial security and the windfall that they're getting? That money is going straight back into economic activity. So the debate that I want to have about whether negative gearing's worth keeping and whether, private investment into real estate, and we are talking tens of billions of dollars every year of new investment flowing into multiple states and territories. So we're in that probably $50-60 billion of investment coming into that market. Fast forward 10, 20, 30 years like those baby boomers are doing, they've now got that cash or they've now got that passive income. That is why the economy continues to keep growing. Like if you bring in a social democracy type arrangements, the economy doesn't grow. And so the only way you can provide those services is to go into more debt. And so wouldn't it be better that the debt is taken on by private investors as opposed to government? Because at the end of the day, you'll go broke as a country. You'll completely stuff the joint if you continue down the path of thinking that the government's got to provide those services. So I want to see in the debate and then the economic modelling, what is the benefit of all of those baby boomers? They're travelling, they're spending money, which is being spent at RSLs and pubs, and they're employing people and they're buying caravans and four-wheel drive. They're spending it back in the economy.
Yeah.
And that's the economic growth. There's one job politicians and political parties have to do, and that's run a strong economy. If you do that, you spit off all of these taxes that you need to provide those services.
So that $33.1 billion bucks, and sort of running off that point, through the last election that we just went through, we've written off $16 billion of kids' HECS debts, right, paid for by property investment. We've got $10 billion.
It's already been spent. That's
already been spent. But imagine these numbers growing, right? $10 billion bucks for future housing. That's been spent. Like, I reckon one of the great scalps of the election was the Greens housing minister, who was not re-elected in his own constituency, and he was a nuisance to the Prime Minister, and he was a nuisance to everyone. And his militant approach to demonising property investors, I thought, was eventually called out, but way too long. Yeah, it just called out like that sort of that divisive commentary is not healthy for Australia. No. It's absolutely not healthy. Now, I think the government's got a very difficult relationship with property, because on one hand they need to be seen to appeal to the emotive side of housing, which is
it's a political issue. Yeah,
and then you've got the structural mechanics of how the country's run. The government cannot be running this, so it's got to have this healthy appetite with it. Now, I do bits and bobs in and around the defence and national security space, and we talk a lot about critical infrastructure. And critical infrastructure in sort of normal sense is like fuel security, energy security, actual defence and stuff, all that sort of stuff. I reckon the most essential critical infrastructure for Australia is housing. It's the property economy. Property economy, because to your point, it drives the economic engine of Australia. A lot of people employed in and around property. It's where people live. If we get that wrong, Australia is weak, and weakness is something which can be exploited. So this is where the narrative needs to be. But geez, we get it wrong. We get it wrong at a state, a local, and a federal level.
We do. I mean, that could be a whole different podcast in terms of the red tape and the way in which...
Bryce is shaking his head at that. It's just,
but I think,
what's this guy on?
So what we are now doing is we're changing the market mechanics. And so perfect example is Queensland. 2% deposit, right? So we still read in all of these government reports that, and we look at how's it affordability, and we measure that at a 20% deposit and how long it's going to take to save that 20% deposit. The market doesn't have to save 20% anymore. They only need to save 10, 5, 2 to potentially get in the game. And what I want to stress here is, for the most vulnerable in our community, I am all for making sure that they're protected and looked after.
Absolutely agree.
That is fundamental in, and what makes
that's the obligation of the government.
That is the obligation, and it makes our country the great country that we don't have, to Albo's point, no one left behind. But the question is about all of those other people who then expect that they're meant to get public and social housing off the back of some of the decisions that they've made, who are able-bodied and able-minded, or whatever that may look like. And I also, no disrespect for domestic violence victims and so forth. There's potentially, temporary accommodation and certainly those type of things. But what we want to be able to do is try and teach people how to have financial literacy. Try to teach people in terms of getting onto the property ladder, and some of those new mechanisms with these lower deposits are a way in which people can get onto the market. But we've got to have a reality check here, people. You're not going to be able to buy in blue chip areas. You're going to have some perspective about what you're buying. And if we think that, to live in place and to make, this socio-democracy, it doesn't work. It actually costs more money than it generates from an economic point of view.
Yeah.
And you look at London now. The place is just, it's difficult to see what an amazing city it is. You've got people on these scooters stealing phones. You've got law and order dropping down, and the government's obviously now, at the worst level that they possibly can be from a, sort of confidence, and because they just went too far with this idealistic way of which to run an economy. You've got to get that balance right, and they've overstepped that. And off the back of that, the city is struggling, the economy is struggling. You need to run a strong economy, and you need to have some pretty fundamental things in play there, which is the rule of law and also the rights to ownership. I mean, some of the stuff now that we're seeing in terms of rental reforms happening around, property investors and what they can and can't do with the property that they own, I just think it's overreach.
Certainly is overreach. But I don't know where you stop. And this goes back to the point around what needs to change to actually get us moving in the right direction. Because I don't even think we've turned the corner and we're going the right way. We're still going the wrong way. Red tape, bureaucracy. It's really making it harder to be a property investor. And back to the point, people need to live somewhere. When you think of these 2% type, initiatives that put in place, what I haven't heard, and again, I always bring things back to a really simple way. At 2%, that means the government's, all these co-investment strategies in the government, that means I'm in lockstep with my taxpayers' money is going into helping people into property, right? That's fine if that's what the government wants to do. But no one has asked the question, will banks have the appetite to lend money to people who can't save enough money to even get a 5% or a 10% deposit? Like, as an Australian taxpayer, I don't want to be investing my taxpayers' money in what would be a very fragile asset. And the biggest issue is that, yes, you have incentives to get people into property around housing affordability. A lot of them get trapped in there. And we're not seeing the stories yet, and they will start coming out with going, I made the wrong decision to do this because now X, Y, Z has changed. I can't afford the debt. I need to sell the property. I'm in over my head. My lifestyle's worse, et cetera, et cetera. We need an acceptance in Australia that it's okay that a third of Australians rent. Let's just do that really, really well instead of chasing this utopian dream that everyone should be a homeowner. What do you call it? The incidences now of traditional employment is down to about 50%. That means 50% of people don't do full-time jobs, which means they're gig economy workers, which means banks will probably have a reluctance to lend them money. So that's an acceptance that you need to make. We're not having those big questions, big philosophical conversations as Australians. I don't know. I don't know what you think, Bryce, whether that's fair.
Oh, I think it's fair, but I think to the point. I think when a chicken is breaking out of the egg, if you actually help it out of the egg, it doesn't get through life very well at all because the struggle is part of the strength that's built, right? And I think that's to your point around young people.
It's a metaphor, yeah.
If they, so is it hard to buy a house now? Yes. If you talk to my parents, they'll tell you it's hard. You talk to my grandparents. So across the spectrum, it's always hard. I think what we can acknowledge for younger people now, it's harder to get a deposit. So my view is okay, and because I can show you a bunch of people who have actually said, well, despite that, I'm actually going to get to work and find a way to make this happen. And I think that we are now moving into Australia that I think everyone needs to be. You can't push the river on this. It's happening with or without you. And it's like when Australia doesn't necessarily have the traditional class system that you have in sort of Europe, which was based on whoever owned the land was the landlord, and then the people who didn't have the land, that was where the class divided. Well, in Australia, we were the lucky country, and the Great Australian Dream was the norm. But now the Great Australian Dream is not the norm. We're at this sort of tipping point where a lot of people can, but a few too many people can't. And so what we fast forward 20 years, we will actually have a class divide in this country, like what you see in Europe, based on the fact that landlords will continue to be the dividing line. So people can just have a look at that and go, that is not quite the case right now. So do I actually want to buy into the pity party with everyone over here saying I can't get on the property ladder? Or do I just actually want to get to work and do what it takes, to your point with the gig economy or side hustles, or just get super focused on what it takes to get onto the ladder? And then, because once you're on the ladder, we around this table know once you're on the ladder, it becomes easier to stay on the ladder and progress on the ladder, but getting on the ladder is tough. And so that's the message I'd say to young people that, and yes, we get that the deposit is harder, but get to work and be the chicken that actually fights its way out of the egg on its own, because it's actually going to set you up for a better future.
It's a good way to frame it. And to that point, you know, all these policies come out of government, there are all the rules and regulation around it, but what I'm talking about is leadership on perspective for Australians. Now, everyone says housing is unaffordable. Yeah, mate, I was only looking at it the other day. You can still be buying. I'm just 3 days' time. I'm selling. It settles an apartment, a 2-bedroom apartment in Mount Druitt for $320,000.
Yeah.
Opposite Westfields, walking distance to the train station. That's pretty affordable for most Australians who have a job. So the perspective is the key thing. And this is where we need true leadership, in that we need to shape the attitudes of younger people to understand the property that they start in is not necessarily the property that they're going to raise a family in. That's not necessarily the property they're going to retire in. However, we're still sold this dream that your first home needs to be a $1.6 million house in the Ponds out in the western suburbs of Sydney with 5 bedrooms in it. You know, we're not there. We're so far away from it. And this is even more important than whether or not, you know, there's incentives for developers to build more property or rezoning certain areas to put infill properties. Like, that's all consequence of this, but this is where it really needs to start. But it's not there. It's just
it's not. I mean, but, you know, like in the book, we've got 2 case studies that are about the young struggle, the early struggle, the rent investor or the young professional, the independent person who's trying to get onto that property ladder. And the one thing that they've got in there on their side is time.
Yep.
They're young, you know, and if you start a journey of building out your financial future early enough, you get the benefit of that time and the compounding nature of that. And I think that's, you know, like that's the 6-7 case studies in the back of the book. They are really all about sort of teaching people that it's plausible, right? And it's relatable. And if other people can do it, why can't I? And not playing the victim, just basically getting on with the program in terms of what that looks like.
I don't see that cycle changing, by the way, because that narrative changing, because the power cycle is too short. So therefore, everything unfolds from that, because we're Gen X around this table, and we can remember what our grandparents did, and they started and they put the newspaper up on the windows, and they eventually saved to borrow for the curtains, and you know, back then they were called the drapes, and but we are now going through the cycle such that the clear millennials and the younger generation, if you're wanting to get into power on short power cycles, I can't see that changing.
No, and the concept's not popular to say to people, "Hey, things are going to be hard. We can help."
No,
you.
and that's right.
But things are going to be hard, and be
Correct.
comfortable with things being hard. It's actually healthy for you. Back to your chicken sort of coming out of the eggs.
But you know, the reason why there's this groundswell though is because kids are coming out of university, or you know, in the States, coming out of college with hundreds of thousands of dollars of debt, and they feel like their chance of the life that we had is no longer possible for them. And so they are thinking about this social democracy as a way of reclaiming that power and, being able to do that. Like, look at what's happening in the New York, mayor elections in terms of the Democrats and the Republicans happening over there. This guy's come out of nowhere and he's promising, effectively supermarkets run by government for cheap food and all of the, free housing, rental freezes. And it's resonating because that younger generation feel like they've lost that opportunity. And so I don't think we can dismiss that because it's, if they're feeling it, it feels real for them.
What's that quote that you say about when the population works out the lead?
Yeah. So there's a brilliant quote from Charlie Munger.
That's it.
And Charlie basically says, once the population work out how to vote themselves the money, that's the end of your democracy.
Yeah.
So, and if you look at, there's countless examples. Argentina is probably the classic. If you go back to the late 1800s, this is a nation that's got plenty of land, plenty of natural resources, plenty of natural wonders, like sophistication, smart people, and effectively completely botched their country for the last 120, 130 years because the politicians come in and say, you want that? I'll give it to you. You want that? I'll give it to you. So they come in on all of these promises of, a better life and more services and all, and the government will, and they blow up. And basically the economy goes broke off the back of the debt. They get hyperinflation and the whole thing's a mess. And so then you get, someone new coming in like what we've got now where he's basically just collapsing all of the current infrastructures. He's basically rebuilding the country off a new platform of, guess what? Innovation, entrepreneurialism and business investment. And if you don't have those things, you actually don't have an economy. And so our economy is in its current state because of the amount of government spending at the federal and state levels. If you strip out all of that government spending and you look at private investment spending, we're well and truly in a deficit. GDP would be down and we're basically, in a recession. Now, per capita, we're in a recession, but it would be far worse if it wasn't for all that government spending. And obviously, what do they call it? The care economy and all of those. So we are spending an enormous amount of money, and now we've got all pressure with defence, in terms of with an uncertain global outlook. So we've got spending problems, but the only way you can grow that is you have to outgrow to raise that revenue. Otherwise, you tax the crap out of people, and ultimately
which is what's happening right now. And we've just gone through a federal election, and Australia was very clear on who they wanted to have in power. So the sentiment would, it's a democracy. That's the way they feel as though it should be now. And what I would say to that is that we've probably got the crowd in power right now for 2 terms. It's going to take some going for them to change the way Australia voted in
unless they
3
completely
years.
botch.
Unless they completely botch it, or
Botch the
something
economy.
happens way outside of their their control globally. So the training wheels are off. The government, they've had their first term. You've seen the Treasurer coming out saying he wants to cut red tape and regulation, all this sort of stuff. I just see more and more rules being put in, particularly around property investment, and that's what this particular show is about. All the clues on how to actually do this and do it well, irrespective, I would say, of the machinations the government would be in how to retire on $3,000. Like that's timeless in many ways.
Let's bring it back again to some of that ATO data, Phil. So what I've been analysing is previous 5-year periods, okay? So off the back of the changes to the negative gearing, the capital gains, 50% concession, we were averaging around 60,000 new property investors coming to market. So that's private investment coming into the market, that's creating jobs, it's creating an industry, blah, 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 in terms of that. Then so that's sort of, you're looking at the turn of the century. Then if you look at the next 5-year period, in the next 5-year period, we have roughly 55,000, then down to 50,000. If you look at the last 5 years, we're down at 10,000 individual property investors coming into the market. So that is a radical change where your growth rate is running at 3 to 4%, you're now running at less than 1%. And so let's bring it back to practical terms. We've got a supply problem in property, and that supply problem can be fixed by 2 parties. owner-occupied buyers or investors. And the way in which the government is regulating property and regulating investors in certain states and territories, they're saying tap out. Like there's no incentive. The risk is higher than the reward. Like if my free cash flow return is 5% on bonds or 5.5% in the US, why would I risk spending $500,000 or borrowing money to invest if my returns are not even that, or if my costs, if all the money I'm collecting is going to land tax or going to government or going to higher compliance costs, minimum standards costs? They're basically taking the opportunity out of the investors' hands, and those investors are voting with their wallets and their feet, and they're potentially putting in that money into somewhere else. So then you come back and say, okay, now the government's got to fix it. Okay, so now we need hundreds of thousands of new dwellings for social and public. That's billions and billions of dollars of government investment. That's higher taxes. And so the people who might be anti-property investing, well, when it starts hitting their own, they're not going to just hit property investors for that tax. That's every person in that state or territory who's going to pay higher taxes in some shape or form. And that, again, squeezes the economy and doesn't let the economy thrive. And we need that public and private investment to make that economy thrive.
Yes, middle Australia gets squeezed with that because your sophisticated investors typically have sophisticated strategies, right? They can maneuver around that. But it is a challenge, it is an issue, and I do acknowledge how big a challenge it is. Yep. Like I don't have the answers, and I do acknowledge the realities of trying to get into the property market today. But there's always going to be challenges around it. There are ways and means of doing it. We have a very friendly audience here on the Smart Property Investment Show. Most people are dialed into the idea of this being a vehicle for wealth creation like you have on the property couch. So while I've got you guys, I just want to talk about some stuff I'm seeing that I'd like your views on. We'll just go to another break. Stay with us, back in a moment. Welcome back, Phil Tarrant, Bryce Holdaway, Ben Kingsley, chatting through all that's right. Maybe wrong with property in Australia. Now, while I've got you here, Ben, we're talking about getting into property. I'm seeing a couple of things and it's sort of going under the radar a bit, but I'm starting to hear from some people in and around the accounting profession and also within some of the government bodies that they're starting to have a lot closer look at trust-based lending, particularly this concept that as long as your trust is negative, is neutrally or positively geared, it won't be considered when it comes to additional lending. And some of the stuff I'm hearing, I know a lot of accountants who we would know well are pretty much going, they're staying away from this as a barge pole. It's a bit grey and murky, but there's other accountants who potentially are providing the information required that might not be accurate. What are you hearing around this?
Yeah, there's a bit going on in this space, and so it's a warning for anyone who's thinking about this type of opportunity. We are hearing that tax accountants are charging $2,500 for that magical letter that says that investment is washing its own face to allow for that borrower to set up a new trust to buy another investment. That is alarm bells written all over it, right? That's conflicted remuneration. That's self-interest, because you've got to also remember that those accountants are going to then do the tax returns for the trust, which is a higher fee. So there's a self-interest in that. Now, it's not very often we have bad accounting eggs, but that would be something that I'd be super worried about. If an accountant is willing to massage the numbers and put a letter together to be part of a submission, I would run a mile from that accountant and I'd run a mile from that mortgage broker. They are committing fraud, and so we want to make sure that there's a big message out there. In addition to that, if I was a lender playing in this particular space, expect to get a door knock from APRA or ASIC and a please explain about how you're assessing those loans, in the sense that are those loans being, if you've got other trust structures, are those loans being declared? Because ultimately the other trick here in terms of helping these young, impatient investors is to not disclose them, because effectively that's not my personal debt. That's a debt that's in another entity. And so potentially I'm not going to disclose those. I suspect we're going to see some announcements, some letters coming out to slow that process down. But I think it's in the best interest. Like, what we don't want is to create another no-doc or low-doc environment where we basically then get speculation in the property space. And And what's also happening, they're being able to, that does require a fairly healthy yield. And off the back of that, that means, well, the healthier yields are on the cheap properties. And so that's pushing everyone into the cheap property market. And so that isn't helping the first home buyers potentially getting their foot in the market. So the unintended consequences of that, including the APRA's 3% buffer rate, is that all of the energy is on the entry-level properties. That's spiking the values of those properties. So I think what we've got to do is have an honest look at this and sort of saying that there are legitimate people who are bona fide, have the skill, the knowledge, have the financial sophistication to be able to do this. But what we are seeing is this really young charge of these young people trying to get in the market and buy 4 or 5 quick properties and make a quick kill. And I don't think that's not a sustainable market that we want to play in.
This is like the next iteration of, and I think, Property Couch specifically and also Smart Property Investment Show, we've really helped democratise information around property investment. So I think we're a bit beyond now people getting stitched up for off-the-plan type apartments. Like people are a lot more educated. But this sort of feels like maybe the next iteration of I don't know what you call it, but an application of property investment which is sort of outside the norm and the boring, which is get rich slowly. So you get into the market, everything gets channeled into the one spot. If you get in there early, you're probably going to get the upsides. But if you get in there late, you're probably going to be stuck with a property for a long time. And some of it driven through the buyer's agent sector as well.
It's a classic economic incentive story. You show me the economic incentive in terms of, so the accountant's got an economic incentive.
Yeah.
They get, the client for life in terms of the trust structure and setting all that. You've got the broker who's getting their economic incentive in terms of so they've potentially found this loophole. And now it's sort of becoming mainstream through social media and those type of things. And then you've got the buyer's agent who also has got an economic incentive to make that happen. So we're interested in a sustainable, and if I'm wearing my picker hat as the chair of picker, we're interested in a sustainable market that removes the speculators and makes sure that property is a long-term investment and it helps the economy and the social impact. Remember that if you're trying to attract the best and brightest into a city and you've got no rental accommodation, you're not going to attract the best and brightest. So it's, that human movement or the human capital movement is an important thing. So coming back to your point around 25 to 30% of rental stock being available, that's actually healthy in terms of moving your human capital around the nation to continue to grow the economy and to continue to see those people prosper.
So interconnected with this, and I'm hearing this from the mortgage broker space, of which you're a sort of major player in, and this isn't like rampant, but I've heard it enough to actually go, there's something here where mortgage brokers are starting to having a level of frustration with buyers agents, where a client will come in and they'll say, I want to buy X property in a trust for all these reasons. And the mortgage broker will say, why are you borrowing at 90%? Why are you borrowing your first property in a trust? Like with their best interest duties, they will interrogate and quiz it, and they're going, we don't want to touch the stuff. Like so accountants are saying don't want to touch it. Brokers are going, you shouldn't be doing this, but it's happening.
It's the 10%, isn't it, Bryce? It's the 10% that spoil it for the 90%.
Yeah, and I've been involved in that in the early noughties too, when there was a specific trust that was being pushed for all property investors, and the challenge was that back to what Ben was saying before about the web of incentives to get people into that trust, and some of these trusts are created with a ruling that for the minorities fine, as soon as they become the majority, that's the challenge. But ultimately, what was happening is, in their own name, they'd have access to this many lenders, and then within the trust, they'd have access to just a slither of the market as well. So it added a degree of complexity, and it wasn't in the best interest of the client. So ultimately, what you're describing on all of the things we just talked about the last 5 minutes is a new wave of where you're right. We've democratized the information, so some of the stuff that we've squeezed out has happened, but now we're trying to find ways. Well, some of the players, including the buyer's agents, are trying to find ways to actually do some of the tactics they did in the wrong asset before, now in the right asset but in the wrong areas, given that location does 80% of the heavy lifting. So forever we are operating in a market where the dominant player is owner-occupiers, and the dominant buyer is owner-occupiers, and the dominant player is a real estate agent. So it's very, very difficult to regulate this space. And for as long as that happens, there will be, for as long as we try and shuffle in our seat to get more comfortable, the same will happen in the marketplace where people will look for different angles. And what you're describing, accountants' letters, buyers' agents who are focusing on a particular area and really ramping up the size of that. Some of them are saying, hey, listen, you want to buy in the Sydney market? Okay, I've got a silver bullet for you. Go and buy 6 really quickly. And then in a few years' time, we'll sell 3 of them. Like, there's just very, very creative ways that are happening for the same thing of ultimately, is it in the best interest of the client, or is it in the best interest of the person giving the advice?
So what would be your 3 sort of checks and balances to determine whether or not your buyer's agent is a good buyer's agent who's actually providing you the right sort of advice?
Yeah, well, I think for me, the buyer's agent would want to be making decisions based on strategy, not tactics, right? So for me, what's the clear North Star that we're going for? And can you show me that that's actually been modelled in a way that's been realistic? So I would want the buyer's agent to be fulfilling a strategy that's got some rigour, not being the person who's actually in charge of the strategy when, in effect, they're doing the tactics. So I'd want to know that they're in the game themselves. I want to know that they've got enough experience. So because there are a lot of buyer's agents who've been there for 5 minutes, and I'd want to know that they are following some form of North Star that has meaningful rigour behind it, other than just here's a back of napkin, you've got an income, you've got some assets, let's go.
So if I read this book, will I be able to work it all out?
I think you will. I think this book's for everyone. I'll tell you why. Because if you're we put on the front, it's for the passive, but for everyone until you get to the case studies at the end, it's for everyone. Because we go to extraordinary lengths to tell you what the foundations of the Australian property place is in this country. So that applies to active and passive. It's only when you get to the case studies, we are very much saying the passive strategy that we recommend is this. Now, if you're active and you want to go and do some of the active things, and some people in this country are really good at it, fine. Yeah. But for the majority of the people, passive is the game that they should be playing.
Particularly when, most property investors own a couple of properties. So get 2 right, 3 right.
That's the good news story, Phil. In concert with super, 2 properties will give you $3,000 a week because you've got 12% earning capacity over your life's working journey. So it doesn't need to be 10, 15, 20, 30. 2 or 3 really good ones owned for the long term will give you $3,000 a week.
And I would imagine that would be reassuring for most property investors to hear that.
Yeah. There's hope out there for everyone, and it doesn't have to be through subdivision development and taking lots of risk.
Yeah. My portfolio is boring. I ain't got the time for the other stuff, but it's probably one of the great outcomes of
You're
it.
the greatest underplayer of your property portfolio.
Exactly.
You are one of the most experienced minds in this country.
Boring.
And underplay what you do.
Thanks for coming in, guys. You get this all over the joint.
Yeah.
I get this when you're traveling. It's a really good plain book. You can pick it up and put it down. I like how you guys have you've structured it so it's one of those things you don't need to digest it all in one crack. So you can come back to it as well if you need to relive the lessons. It's really good to see you guys. We should do this more often. Maybe I'll conclude with this point. One of my greatest frustrations, Ben, this is probably for you.
Right. Is me?
Well, one of many, but and I think we have an obligation here. Mm-hmm. We, as in the sort of collectives, people in and around sort of property that have a bit of a voice. When the government gets together to work out what sort of policy formulation they're going to do, they never invite guys like us down there, right? No. They never invite us. Like the productivity commission's getting together, right? Yeah. They've got a whole bunch of government bureaucrats who have never worked in business down there, who probably don't invest, who are on a nice big fat super thing that's not going to get taxed, Yeah. So the opportunity is actually to speak to people who have a different lens. And it might not be right. People are going to listen to me and just go, you're an idiot. I don't care. I'm just sort of saying as I see it. You're a lot more informed and educated. Your argument's a lot more erudite than mine.
A quick little example.
Yeah.
With the New South Wales reforms, right, for the no grounds evictions. The sort of government departments have come back and said, oh, no, the property managers are sort of okay with it. And I said, what? And they said, yeah, they are. And I said, oh, why would that be? Oh, that's pretty easy because every property listing that they have is worth around $6,000 to $9,000 to the value of their property management business. Of course, they're going to talk it down. But the actual owner of the property that employs that property manager, trust me, if you get the voice of that room of, not having control over your property in terms of who gets to use the asset that you own and control, trust me, that was not the view of thousands of property investors in terms of, this where the reforms have gone too far. So that's a classic example of, all of these reports come out and they have spoken to industry, but why not speak to the 2 million property investors who basically put their hard-earned...
They could talk to them through you with Picker, right?
Yes, that's absolutely.
That's the idea.
That is the idea. Come and talk to us.
All right.
We'll tell you what the actual owner of the property thinks.
Yeah, okay. And I'm happy to be involved in any sort of roundtable discussions around this. And I'm sure, I don't know if you had Claire O'Neill on your podcast yet.
She cancelled. We had her booked, but unfortunately she had to cancel. So we'd love to have her back on.
I think you guys have a very good chat. And Claire, you're more than welcome to come and chat. You've been in the studio beforehand talking about other stuff, but it's important. I think we've shown the economic contribution that property investors make. So happy to get involved in any discussions. Gents, thanks for coming in. I know you've got a busy day.
Yes.
Talking about how to retire on $3,000 a week. You guys all set for this as well? You guys got your personally your...
Yeah, we practice what we preach. We practice what we preach.
That's what I like to hear.
It's not a theory guide. It's a practical guide.
Yeah. Now, thanks for tuning in. Remember to go and check out smartpropertyinvestment.com.au. Go and check out the Property Couch. What's the best way to track you guys down? Just Google that and you can there and find you. The crew at Empower Wealth are always in and around. Doing what they do. Thanks for tuning in, everyone. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.